Studio in New York City. I'm Julie Hyman. That's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. New record highs on Wall Street, an hour until the closing bell rings, and stocks are posting gains across the board. It comes as earnings season begins to ramp up. We're looking at what's driving the market action and the key catalysts to watch.
And we're zeroing in on big tech, the sector outperforming even as investors look for opportunities outside the Magnificent Seven. Chip stocks and AI still taking center stage, but a changing of the guard may be on the horizon.
Plus, the Federal Aviation Administration stepping up its scrutiny of Boeing. The agency now calling for inspections of another 737 model. And we have one guest who says this could be a bombshell. We've got the details and the implications for the airline sector as United gears up to report after the close. Let's get you up to speed on the market action right now. Indeed, we are pushing to new record highs here. However, it's not a very energetic push, at least not today, right? We've got the Dow only up less than 1/3 of 1%, the S&P about 1/4 of 1%, the Nasdaq in line with the others here, but enough to push stocks to new records here, building on the gains that we have been seeing. Once again today, it feels like that there is a bit of a waiting game perhaps for some of the bigger earnings reports as we head throughout the week. But again, the momentum is enough to take us higher.
Yeah. You know, one interesting trend, Julie Hyman, by the way, great to have you back from Davos. Nice to have you back in the chair. One interesting trend people are talking about, we see this green on the screen, as you talked about the momentum, the S&P 500 hitting these all-time highs. At the same time, the little guys, the pint-sized guys, right? The Russell 2000 is still in a bear market, meaning down more than 20% from its high. The strategist Peter Bukvar, who we know, saying on X, easily one of the strangest markets I've ever seen, which is impressive. I mean, Peter has been around for a while. So for him to say something seems weird and odd impresses me. And he kind of just asked his clients this morning, can this kind of dislocation to this extent continue? You know, we'll see. I mean, we now, listen, we'll get more inside information from all these, you know, relatively smaller companies as they begin to report earnings over the next few weeks. But it's an interesting kind of dislocation, as he puts it, compare and contrast that we're seeing here.
Yeah, definitely. And this, as we still have a lot of investors who say they like small cap stocks. So it's even more notable that you have the dislocation in the face of that. Something else, another trend that you and I were talking about is what has led us higher in this market push. And if you take a look at the Yahoo Finance Interactive here, I have pulled up the S&P 500 sectors year to date. And there's a very familiar couple of groups there in the pole position, right? You've got the XLK, which is information technology, and you have the XLC, which is communication services.
Right.
And this encapsulates the so-called Magnificent Seven that everybody was talking about, at the end of last year, we're going to see a broadening of the rally. Right. Guess what? We haven't really seen the broadening of that rally. You've got energy that is slumping. You've got utilities that are slumping, which is interesting this year because these are, particularly utilities, are traditionally seen as interest rate sensitive. So if interest rates are projected to come down, which they are, you would think utilities, you would think real estate, that those would be outperforming groups, and yet that is not the case this year.
Well, I love that you brought this up because we were talking off camera about this, how it was not that long ago. The story was, at least from strategists who were more bullish that we had on the program, there was this kind of narrative we heard, which was, well, why are you bullish? I'm bullish because there's different variables, but a common thing was because the Fed's going to cut early, right? And because I think this rally is going to broaden, right? Instead, what's shifted now is more people obviously getting skeptical they're going to cut early. They're more skeptical it's going to happen in March. And this broadening, we're back to talking about tech. You know, and so it's interesting as we think about whether the rally can continue. What if it doesn't broaden? You know, is that a problem, or can the rally have legs? Luckily, we have a very good person to talk to about this.
We do. And just one more thing on this. In Davos all last week, I mean, AI was almost anything anyone could talk about.
Yeah.
So that tells you something here about what has been driving.
Should I use that as a contrarian indicator, though? If that topic's hot at Davos? I don't know. I'm just asking.
You might, yes. You wouldn't. You would have gotten paid if you had done that sometimes in the past, that's for sure.
All right, moving on. Let's get some trending tickers here. Shares of Gilead Sciences sliding after a new cancer drug fails to improve overall survival rate. A chemotherapy drug was the centerpiece of Gilead's $21 billion acquisition of Immunomedics in 2020. So this one is interesting here. This is about its lung cancer drug, right? And reports are saying, Julie, it didn't improve survival with patients with advanced lung cancer. And from what I read, the drug is approved to treat some kinds of cancer. It's breast cancer and bladder cancer. And this drug we're talking about here, just to broaden out, is an ADC, which is kind of a medication we talked about a lot in the program, because these type of drugs, they target the tumor but minimize damage, I guess, to tissues around the tumor. And you've seen a lot of excitement around these ADCs, and they've been spurring a lot of deal making, right? But some disappointing results, I guess, today from Gilead on this one.
Yeah, and there are very high stakes, and we're going to talk about this a little bit later in the show when we talk about the outlook for M&A in the life sciences. Yep. So many of these companies are seeing patent cliffs for many of their medications, and the pressure is on to have a new pipeline. That's not necessarily the case with Gilead. It does have some products there, but obviously there were a lot of hopes riding on this expanding indication for this drug, which, as you say, is already approved to treat some kinds of cancer. One analyst over at Evercore ISI said the stock sell-off is an overreaction because Gilead still has a growth story driven by its HIV business and not necessarily oncology. But that's not something that investors are really paying attention to today. So kind of, mixed commentary out there in the wake of this with that stock tumbling to this extent.
Yeah, now and the stock down today, now firmly in the red, by the way, over the last 12 months.
Yeah. Let's also take a look at Citigroup shares today. They are trending up after sources telling Reuters that Warren Buffett told Citigroup CEO Jane Fraser to keep going with the overhaul that she's doing. This comes a week after Fraser indicated on a conference call that more information about the next round of Citi's reorganization might come this week. Again, Reuters reporting this, that Fraser had a call with her managing directors at the bank, and she said she had a call with Buffett. And what's interesting about this is we knew that Buffett owned shares in the bank, but we knew Berkshire Hathaway owned shares in the bank, but we didn't know how directly Warren Buffett was involved.
He's so involved that he's having lunch.
Apparently, yeah. So that's why we're seeing this kind of reaction.
Yeah, and it's been a nice run for Citi. I mean, if you pull back that chart since early November, it's up more than 30% now. And we do know, listen, some well-known, it's not just the Oracle of Omaha. I mean, some well-known bank analysts we know like the name. We had Mike Mayo over at Wells Fargo. He was on Yahoo Finance recently, like Citi, top pick, expects shares to double over the next 3 years as the banks. He talks about it as a metamorphosis is going on here that Mike believes in. And it's really Jane Fraser stepping in, simplifying this bank, streamlining it, boost profits, and hopefully the stock price.
Yeah, and he reacted in a note, actually, to this Warren Buffett report. Yeah. He said, quote, "Until now, it was unclear to us and many investors whether the Citi stake was really a Warren Buffett investment versus somebody else at his firm." And he says, well, now, basically, we know.
It's enough to get lunch. We know that much.
Yes.
Finally here, shares of Digital World Acquisition Company are riding high in the momentum of recent Republican primary developments. The special purpose acquisition company just behind Trump media is surging following Trump's Iowa caucus win and Ron DeSantis suspending his presidential campaign. So that's what it looks like it's going on here. Digital World Acquisition. So this is the blank check company looking to take Trump's media company public. Jumping today, hit its highest level, by the way, since summer of 2020. And this move is being pinned on Governor DeSantis dropping out of the 2024 U.S. presidential race. Also, he did endorse Trump, of course. So we see this company's market cap got back over $1 billion, and it isn't just the only name, by the way, getting a lift in today's trade.
Right. I mean, is sort of this mini meme stock universe that surrounds former President Trump, right, and sort of moves in tandem with developments related to him. You have Digital World Acquisition, or DWAC, as we like to call it, after the ticker. There's Funware, which is a software company that worked on his 2020 re-election
I had not
campaign.
heard of that until Bloomberg highlighted it.
Yeah, it's one that we've seen before pop up on our trending ticker page when there are developments, which it's a penny stock, effectively, but that's why I call it sort of meme-y, right? It's a meme stock. There's Rumble, which had other positive news today, which we'll also get to later. But there is, again, this sort of mini meme kind of vibe with some of these companies that, it's not like DWAC doesn't. It's been trying to actually take over Truth Social for how long now?
It's been a while.
And it keeps pushing back the deadline. Usually when you have a SPAC, you have a deadline. If you don't make an acquisition by that deadline, you have to give investors their money back. But DWACS keeps pushing back that deadline.
And check out, now here's another name, PSQ, which I guess runs a marketplace connecting buyers and sellers for what it describes as freedom-loving Americans.
Of course.
Julie, that also was higher in today's trade. To your point, Trump pulling a collection of names higher in today's trade. And we got some smart analysts to talk more about DeSantis pulling out and what it exactly means for the election coming up later in the hour.
Yeah, we're going to talk to Henrietta Trace. She's one of those people. Veda Partners, managing Director of Economic Policy. We're going to talk to her later in the show about the election, about the implications for investors and what we could see policy-wise on either side there. So that's something I'm looking forward to. Well, for the first 2 weeks of the year, expectations were that the Federal Reserve would cut interest rates in March, but a reversal of the target rate probability now showing the first rate cut of the year may not come until May. Joining us now, Michael Green, Simplify Asset Management Chief Strategist. Hey, Michael.
Hey, how are you doing?
The market might have changed that, and there were all these warnings that the market was getting wrong, and they needed to push back their expectations. Okay, so now they've changed their expectations, and stocks are still rallying. It doesn't seem to have been a problem here. So does the timing of that first cut matter for equities?
I don't think the timing of the first cut matters per se for equities. I think equities have demonstrated that they are largely insensitive to the change in interest rates. We've seen some areas like utilities that have suffered from much higher interest rates. But the reality is we went into this narrative saying that valuations for stocks were very high because interest rates were low. And now, of course, now that we've hiked interest rates, valuations are higher. So we have to acknowledge that there was something broken in that model. Ultimately, I think it has much more to do with the dynamics of just simply flows into investment vehicles rather than some idea of some discounted present value that the market is trying to price in.
And Michael, I want to get your take on, Julie, we were talking at the beginning of the show about this, about how the narrative seems to have shifted, at least for some, Michael, that we had any number of smart strategists. It wasn't that long ago saying, they were betting on 2024, the equity market was going to run higher, and the story was, well, the Fed's going to cut early, and this participation is going to broaden out. As we were chatting, Michael, now markets more skeptical that they're going to cut early, they're going to cut in March, and really we're back to just talking about tech, but the market seems to want to keep moving higher. How do you think about that, Michael? What explains that? Does that just come down to, economic data keeps coming in stronger than expected? Is that it?
Well, I think the economic data has come in stronger than I think many people had anticipated, given kind of expectations for a recession. But we have unquestionably seen things like hiring slow down dramatically. Job openings are slowing down dramatically. We are seeing corporate profits that actually, in aggregate, disappointed for 2023, despite the fact that you had a huge rally. And now, of course, we're expecting end of year 2024, roughly the same level of earnings that we expected at the end of 2022. So I'd suggest it has much less to do with fundamentals. It has much more to do with the actual underlying dynamics of how trading is done today. We have an incredible supply of short volatility. People are selling call options. When those call options mature, they're ultimately forced to buy back those positions. Dealers are hedging, et cetera. Those dynamics lead to this kind of slow, continuous melt up. And in the background of all of this, we just have the share buybacks coming from those large tech companies that are continually propelling their shares higher, while the rest of the market is really struggling in many situations. Looking at 2024, today is the exception with the Russell 2000 up sharply. But year to date, we've had terrible experience across many sectors with, many of the stocks that were up strongly in the fourth quarter of 2023 now down anywhere from 10 to 15%.
So, Michael, if there are these sort of underlying dynamics that are supporting the market overall, but you have these weakening fundamentals inside, like what is going to be the thing that flips the switch, if anything?
Well, I think you used exactly the right phrase, flip the switch, right? It is you have to actually cross over that point, right? Kind of playing with the switch and pretending to flip it is not going to turn the lights off. It's when you actually flip it. And I think everybody at this point is broadly acknowledging that the key really is the labor market, which has remained very strong in terms of unemployment and the number of employed individuals. If that starts to deteriorate, then we could actually start to see things like 401k flows, retirement flows, et cetera, move significantly lower. And then the other component, of course, that's paradoxical to, I think, a lot of people is that the Federal Reserve, having hiked interest rates, that's sending an unbelievable amount of income out to the older generation. That means they don't have to sell their stocks or harvest their stocks. They can now generate returns off of their cash balances or investments in fixed income that they couldn't have done 2 or 3 years ago. And so paradoxically, if the Fed cuts interest rates, we could actually see a deterioration in that household income that is currently being supported by those Fed hikes that's driving the deficit to such extraordinary levels.
And Michael, one point, you bring up, I mean, listen, there's a lot of cash on the sidelines. There's trillions of dollars sitting in money market funds and CDs. I mean, if the market keeps grinding higher, though, Michael, is that a potential tailwind for the equity market here in 2024?
Well, I think that's the key question. Do we actually see people aggressively try to move that money out of cash balances and into the equity markets? The perennial cash on the sidelines argument runs into this narrative of, well, there's always going to be cash on the sidelines because every buyer has a seller. The simple reality is if those buyers get very aggressive, if they decide that with the Fed cutting interest rates, that maybe they need to move back into equities, then they'll pay higher prices and the markets will advance. But in the meantime, people are just continue to steal a phrase from the crypto world, stack their dollars and benefit from that sweet, sweet interest rate.
The sweet, sweet interest rate, keeping people out of equities for now. Michael Green, thank you so much. Appreciate it.
Thank you.
We're just getting started here on Yahoo Finance Live. Coming up, Ron DeSantis has ended his presidential bid. So what's next for the governor of Florida? Could he be Trump's choice for a running mate? We'll discuss later in the show. Plus, it's wheels up for earnings season. UAL is going to be the first major airline to announce earnings for the fourth quarter. We're going to break down those numbers after the bell. And the newest edition of our series, Goodbye or Goodbye. We'll get analyst insight to break down 2 major pharmaceutical retail stocks and help you make the best choices for your portfolio. All that and more when Yahoo Finance continues. New developments in Boeing's 737 saga. The Federal Aviation Administration telling airlines to check door panels of their 737-900ER aircraft. It has similar door plugs to the one that came off in Alaska Airlines flight earlier this month. Yahoo Finance's Pras Subramanian here with the details. So now, basically another aircraft being affected by the scrutiny.
Yeah, I mean, exactly. Additional scrutiny here for Boeing. The FAA recommending that airlines check the 737-900ER for these door plugs that are similar to the ones in the MAX 9 jet. Now, the 737-900ER is a last generation of that 737, a workhorse jet. Lots of, about 500 of those planes out there, mostly with Delta, United, and Alaska Air too. So there's a lot of jets out there with this potential plug. No issues yet, but they want to increase that inspections or just for enhanced scrutiny because of what happened with that Alaska Air flight.
Yeah, I did see one commentary, I think from United, that they're trying to get this done quickly and hopefully get the planes back in the air, but we don't know what's going to happen.
Right, with the MAX 9, you mean, right? Yeah.
And the new one.
Well, they haven't grounded those flights.
Okay,
They just saying check out the doors, not grounded. But you're absolutely right. I mean, initially when we had this whole investigation on the 5th of this month when that incident happened with Alaska Air, Boeing wanted us quickly get out here's the plan for inspections. It's all good. Let's keep flying. And the FAA said, no, hold up. And that's been the process since then. We've been seeing a grounding, the FAA saying the plans are inadequate, the FAA increasing scrutiny over Boeing's manufacturing practices as well as Spirit Aerosystems manufacturing practices. So it's been expanding and getting worse and worse, I guess, from a Boeing point of view, because these MAX jets are not going to be anywhere in the air anytime soon, as far as I can tell.
All right, Boeing looks like it's edging lower in today's trade. Dan, I know about 0.4%. Thank you, Bryce. Appreciate it. Moving on, chip stocks we know have had quite a run to start the new year. Expectations the Fed will lower rates, positive guidance as earnings season begins have caused semis to rally here in the new year. So far, the SMH, the ETF that tracks the chip, is up more than 7% this year. And with more earnings reports to come, all eyes on tech and the leaders in AI. Let's bring in Dan Morgan, Synovus Trust Senior Portfolio Manager. Dan, it is good to see you. So,
hi, Josh.
Let's get right into the chips, Dan, because we look at the SMH, the ETF that tracks the chips. It's up about 7% already this year, Dan. You pull back the chart, it's up about 60% in the past 12 months. I mean, generally, you want to see expectations tempered if you're an investor heading into some earnings prints. But just broadly, Dan, give us your view as these chip companies start to report, AMD, Intel, NVIDIA. What do you think we're going to hear from the sector? Is it going to be good news that chip investors are going to want to push these names even higher?
So, Josh, I think what we're seeing is that we hit a bottom in the stocks in terms of revenues. Basically, the February of 2023, we've had 10 consecutive quarters of year-over-year growth in overall revenues in the chip space. And I think that's that momentum that you're seeing right now. You know, if we look at the price-to-book ratio on the stocks right now, it's about 5.2. For example, back when we had the dot-com bubble, it was over 8. So we're not really, from a valuation perspective, in a position where I think you'd have to be overly concerned. I would expect Intel to come in numbers. I believe they're going to print on Thursday. Those numbers should be really good. AMD will follow. We'll have Texas Instruments and Qualcomm, and I expect reports to be positive. And I think what we've seen, Josh, is that after we had the big blip in terms of the work from home and PCs and smartphones and laptops really jumped up and then they fell down, now they're coming back again. So I think we're seeing a real positive flow right now in the chip space. I'm very optimistic. I think if we look at the expectations for overall growth this year in terms of earnings, they're somewhere around 35 to 40% year over year. So good things coming out of chips fiscal year 2024.
Hey, Dan, it's Julie here. I want to talk a little bit about how much AI is playing into that equation and how much of it is other stuff, right? I was just at the World Economic Forum in Davos and spoke to Matthew Prince of Cloudflare, and he had an interesting comment about AI. I want to play for you what he had to say.
I don't think AI is going to fade over the long term, but if I had to predict, I would say 2024 is going to be kind of the year of the AI letdown. It's going to make us recognize that it's really easy to create an AI demo, which is incredibly impressive, but it's very hard to take that demo and turn it into a product. That doesn't mean we won't turn it into a product, but I think it's going to be harder than we think. I don't think those products are going to come in 2024. They may not even come in 2025.
So, Dan, I'm just curious, hearing that, A, do you agree? And B, how is that going to play out when it comes to chips where there are a lot of high AI expectations baked in?
Yeah, Julie, so I've always taken the point of view on AI that's somewhat similar to your previous guest that you spoke to last week, and that is that I look at AI as kind of a productivity enhancement tool that will help like digital ad spend with Meta and Google and TikTok and so forth and Amazon. We haven't really seen it really impact, let's say, Microsoft with ChatGPT. We haven't really seen Alphabet with Bard really have a dramatic positive increase in terms of profits. I think the one area, Julie, you kind of kicked it off with that was, how does it impact the chip manufacturers? And I think they're the one group that probably will get the biggest bang for the buck. And we've already seen that with NVIDIA. We have Intel coming out with new chips. You might have gone to the electronics show in Vegas a couple of weeks ago. And AMD and NVIDIA both came out with their AI PC chips. So I do believe the chip sector in the manufacturing area will get a good boost in 24 from AI, especially data center. But I agree with your previous comments with your guests that I think it's more productivity enhancement. It's going to be very hard to really say, wow, ChatGPT for Microsoft accounted for a 25% jump in growth. Does that make sense?
Yes.
And Dan, it's not just AI. I mean, for the chip names we're talking about here, as you noted, I mean, the important end markets include PCs and smartphones. I'm interested, Dan, when you look at those two verticals, do you think they've bottomed here, Dan, and would you expect growth over 2024?
Yeah, you're right, Josh. So those are the groups that had the big bounce after COVID, work from home, and then they came down. It's about a third of the market, right? PCs, laptops, and smartphones. I expect those to continue to kind of get out of the hole, while let's say industrial and auto, which was very strong, let's say a year and a half ago, everybody remembers the auto manufacturers couldn't get enough chips, right? And they were just selling them for whatever price they wanted them. Now they've become a little bit more muted. So, but that's a big part of the market, along with memory. You think of Micron and Samsung. So I would expect, Josh, a bounce back in those core groups, those old laptops, smartphones, and PCs, and DRAM, and the more emerging groups, which auto, industrial, slowly working back in the fold. But again, looking for good things out of chips into the new year.
So tell us, Dan, which of these companies' earnings reports do you think is going to be the biggest catalyst? Like, where would you most be a buyer going into earnings for the semis?
Chips, I mean, obviously NVIDIA, but that's going to be a delayed report, right? Because that's going to come out about a month from now. I expect, Intel had a really good print on their last quarter, which is their Q3, and I expect that momentum to carry through. They've got a lot of AI chips that they're going to be bringing out next year. I think there'll be a lot of enthusiasm for AMD. They have the MI300A and MI300X, which are both of their core AI chips. They're going to go head-to-head against NVIDIA. I expect, a lot of fanfare surrounding that. So more in that club, Julie, in terms of data center, opposed to other sectors within chips that, are recovering. That's still the hot space right now in terms of making data center chips in the AI area.
We'll hear a lot, Dan, too, from these companies when they talk. Really, some of them are going to talk about kind of their opportunities in China. I'm just curious, Dan, how you think, for chip investors who are listening right now, should they think about China still as a really healthy, long-term opportunity for these chip names? You have Chinese political leaders. They've come to the United States. They were in Davos. They say, hey, listen, we're open for business. Do you buy that, Dan? Do you think it's true they're really open for business? The rhetoric's there, but in practice, do you think that's true?
Yeah, I mean, you think about China, you look at companies like Qualcomm derive 70% of their revenues almost from China. Micron's about 15%. You go down the list, Intel, NVIDIA, all these companies are impacted what goes on in China. And Josh, you and I have talked before when I've come on the show about this kind of trading of these restrictions and, will China still be a good market for the semiconductor manufacturers? And I mean, it's 1 billion people. I still expect it will be. I'm hoping we can work these things out. I mean, some of the rhetoric that you just mentioned sounds good, right? It hasn't really shown up so far. But I'm hoping we can iron this thing out and get back to some sort of practicality in that space. Because I don't expect these big North American producers who do a lot of their manufacturing over in the Pacific Rim to give up on China. It's just a huge market. Applied Materials does a tremendous amount of business there in the equipment space. So again, it's a huge economy. It's a huge growth segment for them. So hopefully we can iron out this combative, restrictive type of thing that we've been doing.
Dan, I agree that the rhetoric coming out of these Chinese officials sounds better. We'll see what it actually means in practice. Dan, always love having you on the show, sir. Thank you so much for your time and your insight. Appreciate it. Still to come on Yahoo Finance, the newest edition of our series Goodbye or Goodbye. We're putting CVS and Walgreens to the test and getting investor insight to help you make the best choices for your portfolio. Stay tuned.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're checking up on the best way to play the shifting healthcare landscape, particularly when it comes to the retail side. I'm here with Alex Morris, FM Investments President and Chief Investment Officer. Good to see you. Thanks for coming in.
Thanks for having me, Joe.
So let's get to your buy on this side of the equation, and that is CVS Health that we were talking about here. Here's the stock over the past year. It's kind of trended a little bit down, but let's look at some of the catalysts that you say can help it from here. Experienced leadership, first of all. Talk me through that one.
So leadership team has been intact for a long time, which in a changing marketplace isn't always true. And this leadership team in particular has shown the ability to grow the business and to grow it on like metrics and to keep what is a pretty competitive space very competitive for them. So I like the way they've positioned themselves and their consistency.
What's interesting too about CVS is obviously it's not just a pharmacy chain. They now have a much bigger business and that vertically integrated business model where they offer insurance as well.
Right. Their merger with Aetna took them out of just the shop that you see on every street corner, which is good for the first part of their business. But now they're vertically integrated across all parts of what you need in keeping yourself healthy. So when you're going to go to buy something like a prescription, you're going to buy other items from the store as well. And that's something their competitors just don't have. Now, that also has with it all of the headaches that come with being an insurance company, but some of those are some pretty attractive financial metrics that we really like that will hold them through what might be difficult retail times in the coming weeks and months.
Let's talk about the financial metrics now, because you are looking at things like free cash flow and earnings growth. If we take the latter of those and look at earnings growth, there it is. Here's the earnings per share growth that we've seen over the past few years and the estimate for this year.
We like the trend line. I mean, everyone would expect this to be for every stock. It's not. Not every stock can be an AI chip stock, but we like the growth rate, and we like the fact that they're also using their free cash flow well. So growth rate is going up, and they also beat estimates, which I think is underestimated. Really like a company that not only is growing, but that can reliably beat the street. And when that happens, stock prices tend to follow. They tend to follow with a little extra pop. So you get the good underlying company, and then we'll benefit for that underlying momentum translate into higher prices.
We also like to talk about not just what the bull case is, but what could go wrong. And you sort of alluded to it when you said there are advantages to having this integrated model, but then there are some risks. And one of the risks is a medical loss ratio, which is basically a metric that you look at in the insurance business. How much of your premiums are you paying out to take care of patients?
Yeah, the biggest problem is they're also an insurance company. So folks have put off getting some health care during the pandemic. Some of that has trickled through to today. More folks can come back. Plus, it's healthcare. There's a lot of things that can go wrong in running an insurance company. They do it well, and we like their ability to monetize elements of that value chain, but they're still running an insurance company. And when things go wrong in the insurance company, you can have an unlimited amount of money needed to take care of your health. You don't have an unlimited amount of money for Skittles. So we see that as a risk, but so far they've managed it very well.
And just to be clear here, do you guys have CVS in your portfolio?
So we do have CVS in portfolios.
Okay, gotcha. So that's the good buy. Let's get to the good buy, the one that you do not like as much in this space, and that is Walgreens Boots Alliance here. And there, the stock has been a worse performer over the past year. Here too is sort of the inverse of the other, right? We're starting with high leadership turnover.
They just can't seem to keep a lot of folks in the top chairs. And you see that across strategy, and they haven't had a really coherent strategy. And you see that across just all the business units they're trying to operate, where when you don't have that sort of coherent leadership, you don't get a single message. You see that translating in the stock price, you see that translating in earnings. And we're going to see that in some other charts where they just can't seem to make good investments reliably. And that's a problem when we want stocks to go up over time based on good investing.
Right. And then the other sort of inverse is that it's just a pharmacy chain, right? They don't have insurance in some of the other businesses.
They have no offset to what has become a very big shoplifting problem. I mean, you walk into most Boots, most Walgreens, most CVS to that extent as well, but shoplifting has become a big issue. Some stores are closing, particularly in high traffic areas where municipalities haven't been able to combat that. And without an offset to that, without a reason to bring people into your brand store, it's hard to really justify keeping some of those stores around. And when that's your only revenue driver, that's a problem.
Yeah, interesting. And then finally, if you look at what's going on with their free cash flow and earnings, you've got sort of not as clear a picture.
Yeah, it's a mixed message here. And if we looked at this on a free cash flow basis, we would see that CVS is growing at about 17% a year. Walgreens Boots is contracting at about 50% on a 5-year basis. And that's just going the wrong direction. So although they trade a little cheaper, they have a greater dividend yield than CVS, they don't seem to make good investments with their own capital. And for the short run, that might be nice for short-term dividends. It's not great for the long-term outlook because eventually they'll run out of money.
Right. And then if there's something that could go wrong for your bear thesis in this one, it's perhaps the new CEO of the company, Tim Wentworth. There is some optimism that is surrounding his appointment that he might turn things around for the company.
He's an industry veteran. He's done these things before. I think he will be successful in the long run. The risk to our thesis is he successful faster than we might expect? And if he is, then it's great news for WBA holders. But it's going to be a big ship. There's a lot of moving parts. They've got a much more pronounced international business, which always is harder. That brings in dollar risk to it as well. So they've got a lot of moving parts. He's got a tough job ahead of him.
And when you talk about positioning in Walgreens Boots, are you short the stock or you're just not invested?
We're just not in the
here?
stock. We're not short it. I mean, as you saw, the charts look similar. Walgreens Boots just a little worse.
Right.
But we don't think it's a terrible stock. Certainly, it's a profitable business still.
And when you're talking about CVS, you're looking at sort of a longer term play when it comes to that company?
It's a longer term buy. As you saw the chart, it's a nice, easy curve up into the right, which is what we want to see. Most of these names, health insurance names, don't get a lot of short-term action. This isn't a day trading stock. This is a long-term hold stock.
Gotcha. All right. Well, let's sum it all up, shall we? You're telling investors buy CVS The leadership team drives success. It's experiencing growth in its business. On the other side, you say avoid Walgreens as it endures high leadership turnover. It's also experiencing a contraction in its business. Alex Morris, thanks so much.
Thank you.
Good to see you. Thanks for coming in. And that'll do it for the latest installment of Goodbye or Goodbye. Look out for new episodes 3 times a week at 3:30 p.m. Eastern. We'll be right back. The Dow on track to close at a new record above 38,000. And so far this year, it is U.S. stocks that are outperforming. So Jared Blickery is here in front of the big map to give us the details.
Thank you, Julie. It's not just the U.S., it's really specifically large cap U.S., and we're going to take a look at that in a second. Let's go to a look at our indices around the world on a year-to-date basis. And I'll decode some of these tickers for everybody, but this is year-to-date. And up front here with 9.2%, that is a Nikkei. Over in Japan, they are up to a 34-year high, not quite at a record, but almost there. 1989 was the year that they topped out, finally regaining it, and it did take quite a long time. Then we have Malaysia. Probably haven't heard a lot about that. Not a huge capital market, but nevertheless, it is outperforming the Nasdaq and the S&P 500 in the U.S., and also the Dow for that matter. But if you take a look at the green, it's basically the United States, Japan, and a couple of developing markets here, and really not a lot else. And what's really dragging the world down, I was taking a deeper dive into this morning, is China. Hong Kong is down 12%. Shanghai Composite is down 7%. The Kospi itself is down 7%. And why is that important? Well, the KOSPI is a really good proxy for the chip market. And despite the fact that we've seen this huge rise of interest in AI, it really hasn't translated into a lot of love for the KOSPI composite index right there. And in fact, a lot of that love is just being expressed in NVIDIA and AMD and other US companies. There's a lot of love to spread around, but I'm just noticing the trends year to date so far. Also, what I want to show you is the Russell 2000 here. Small caps are down 2.3%. And if you take a look at a 2-year chart, that is just a bunch of chop. But we did have a small breakout. It looks like it was a false break to the upside. As long as we're hanging around right here, there is a decent chance of a short-term pop above there. And that would mean a lot for breaking out of that 2-year range. But we are not quite there just yet. And then I want to show what's been happening inside the sectors as well. Tech, no big surprise there. That has the likes of Apple and whatnot. Tech is up 4.5%, followed by communication services. That's a Meta and Alphabet story. Then we get into healthcare. Healthcare is a divergence from what we saw last year. It actually picked up at the back end of last year. Here is a 2-year chart, and you can see it itself is in a multi-year range. And in fact, healthcare is in a 5 or 3-year range. If it were to break above, we would expect a lot of momentum to carry it, but so far we aren't there. But suffice to say, it's really been a story about U.S. large cap tech. Can't get away with not saying the Mag 7 this year, but fortunately we have a new entrant, healthcare.
All right, big trend to watch. Jared, thank you so much. Appreciate it. Meanwhile, shipping rates skyrocketing amid ongoing attacks against commercial ships in the Red Sea, rising 23% in a single week as of January 18th. Thus far, U.S. airstrikes have not stopped Houthi forces in the region. What do these disruptions mean for consumers and prices? We're joined now by Stephen Schwartz, Wells Fargo Global Receivables Trade Finance EVP, the Supply Chain and Global Trade Division of Wells Fargo. Stephen, it's good to see you. So the attacks continue, Stephen. The disruptions continue. We've seen this increase in shipping costs for companies, Stephen. Can you help us just kind of quantify that increase in shipping costs? Is it near now, Stephen, the rise we saw during COVID?
Well, first off, thank you so much for having me today. The disruption in the Red Sea is leading to longer delivery times as a large percentage of the ships are continuing to avoid the region, which is certainly having an impact on global capacity. And it's really that impact on global capacity which is impacting shipping costs, which have certainly spiked in the last 2 months, but they're really not anywhere near the levels that we saw at the height of the pandemic. So to date, we have seen impact really hitting Europe, mostly around supply chain disruptions, but it also impacts China as well, given their export-reliant economy. But we haven't seen material impact in the U.S. to date.
And do you think that we will start to, Stephen? I mean, it seems to me this has already gone on a little bit longer than some analysts might have predicted here, or has been more severe. And so at what point, what's sort of the tipping point where we could start to see these higher costs as a result of this maybe spill over into higher costs for consumers or the wholesalers who are buying this stuff?
Yeah, I think it's a really good question, but it's also a very complicated question. And it's not just about shipping costs. So with the help of our Wells Fargo economists, we look at a lot of data, especially around consumer demand, like inventory levels, port activity, timeliness and completeness of deliveries, in addition to key labor statistics and more. So while we have not seen the disruption in the Red Sea lead to material impact in U.S. consumers to U.S. consumers today, right, we're continuing to monitor the situation closely. And certainly the risk of impact increases the longer the disruption continues.
Are there certain sectors, industries, Stephen, that are more at risk to these disruptions than others?
Not particularly. It's with the way that supply chains work today, it's truly a global supply chain world that we live in. And so it has there's a trickle down effect, and it really has the impact to hit all companies.
And so what is sort of the next thing to watch in this evolving situation here, Stephen? It seems like we're sort of going sideways, for lack of a better word. It doesn't seem like things are escalating more at this point, but it's sort of a bad situation just persisting.
Yeah, look, we're going to continue to watch the economic data as it comes out. We're going to continue to watch the geopolitical tension across the globe. And again, it's a complicated set of factors that can impact inflation coming from supply chain disruptions. And so at the moment, we're at a wait and see approach. But again, as we've seen, that can change very quickly.
And Stephen, if, for companies who are dealing with this, any guidance or thoughts about how they should be responding? Should they be focusing, for example, on what they should be expediting? Should they be, building up inventories by 10 or 20%?
Yeah, I would say two things really have come to mind. So we already saw a big shift coming out of the pandemic as companies started to move away from just-in-time inventory. And they've really focused in on inventory timing and decisions that they need to make, especially around seasonally important inventory, where if you miss those windows, it could really have a lasting impact, right? And they've also worked, another thing that's really come out of the pandemic is that they've worked to diversify their supplier base. I would definitely see those two trends continuing.
And Stephen, since you do the financing for some of these companies, sort of what's the backdrop for that right now? How stretched are companies? Do they need to, especially with an environment where it looks like rates are starting to come down, are things sort of loosening up? In other words, they have sort of more flexibility now than they did, say, a year ago.
I would say they not only have more flexibility, but we've definitely seen companies take a more proactive approach to maintaining inventory levels. And so I think that's one of the reasons why you haven't seen as dramatic of an impact in the U.S., because companies are in a better spot today than they were at the height of the pandemic.
Stephen, thanks so much for joining the show today. Really appreciate that time and insight on this issue, and we'll keep watching. Thank you.
Thank you both so much.
OpenAI is the latest tech firm reportedly caught in the crossfire of antitrust investigators. The Justice Department and FTC are in discussions about a probe into the company's involvement with Microsoft. That's according to Politico. Yahoo Finance's very own Dan Howley joins us now for more. Dan.
Yeah, I mean, this would be a huge deal if either the FTC or DOJ went after OpenAI and Microsoft. If you think about it, Microsoft has invested billions of dollars into OpenAI to date. They're more or less Microsoft's AI arm at this point. Microsoft has their own AI business, of course, but OpenAI really is a huge part of that. And so if they're forced to separate or kind of break up their partnership, we really don't know anything along those lines if that would happen, or really how this investigation would unfold if it actually happens. But it could throw a huge wrench into Microsoft's plans for its growth on the cloud part. Now, we keep talking about AI in general, but really where that kind of shows up is in its cloud business, right? Its Azure business. It's whether that's helping companies run their own AI capabilities or Microsoft running its own AI capabilities through Copilot for 365 or Copilot Pro, which is the new consumer offering, $20 a month per person. So it would really damage what Microsoft is trying to build up here, as well as OpenAI, because let's face it, they're getting a ton of money from Microsoft, and they're using Microsoft to help build out their capabilities. So they're really super reliant on each other at this point. And one of the points that they bring up in this Politico article is the influence that Microsoft had during the kind of kerfuffle with Sam Altman being ousted and then coming back, I guess taking a long weekend, we could say. They were going to hire him, right? And then seemingly they helped make everything copacetic again. But the fact that they're so reliant on each other at this point, it raises concerns if this is an actual investigation, or if there's even an inkling of it.
Right. I mean, there's a lot of interesting stuff in here because there's now seems to be, it's very, very early to the point where they can't even decide if it's the FTC or the DOJ who should be doing an investigation, if there even should be an investigation. So that also raises the question, it's an election year, right? So even if they figure that out, is it going to change if someone else gets into office?
Yeah, I mean, look, these investigations take years, right? I mean, we're talking about the potential for Apple to maybe sort of kind of have an antitrust suit brought by the DOJ. We've been talking about since 2020, right? I mean, we've been writing about that, how this has been coming for so long. And so, this is something that still could take years and years if it ever actually gets off the ground. There's no guarantee that that'll happen, that these things are very complicated and sometimes they come and go, and companies, are totally left intact. So, but I do think it's just, important to keep in mind how necessary the two companies almost are for each other. Microsoft basically being the engine that's powering OpenAI, and then OpenAI putting that horsepower to work for Microsoft. So I mean, they're very intertwined at this point. You can kind of consider them, you can't really consider them one company, but it's close enough where you're like, ooh, you guys are real tight.
Dan, always great to see you. Thank you for that. Appreciate it.
For sure.
Coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
There is the closing bell on Wall Street. So let's do a check of the markets here. As we've been talking about all day, it looks like we have new records here as we have stocks continue their climb. And what's also interesting, we were pointing out earlier what's been going on with the small caps in this environment, right?
Yeah.
Yet the small caps, I believe, were coming back today, even though, as you pointed out, they're still in a bear market, even as we have seen the rest of the larger companies rally here. And we've had a lot of investors say that they like the small caps, but it hasn't sort of panned out that way. Meanwhile, the largest of the large caps, the big cap tech companies, they're coming back. What Meta's now recouped all of its losses.
Yep.
So that's what we've been seeing.
We're waiting for the broadening. We're still waiting for the broadening.
We're waiting for the broadening, exactly.
Let's get to some individual tickers today. We're going to start with ADM shares. They plunged today after the company slashed its earnings outlook, suspended its chief financial officer. This coming amid an investigation into the company's accounting practices. So this was a rough day if you were long this name, obviously, Julie, down more than 20%. So suspending the CFO, he had been there since 2022, cut their earnings outlook, and what is now this investigation, it sounds like, into their accounting practices, the SEC asking questions, ADM saying this is about what they refer to as inter-segment transactions involving its nutrition unit, which I guess makes ingredients for human and animal foods. Company saying it's cooperating with the SEC. Bloomberg has a good write-up on this, by the way, knowing that with this nutrition business that we're talking about here, it's been challenging. Operating income was already forecast to drop about 20% in 2023, lowest in about 3 years. And analysts now saying with this investigation, we could see even lower margin for the business segment here.
Right, exactly. So it's just sort of bad news on top of bad news here. The company had been expanding that nutrition business, right? And it was one of the things it's been a victim of is the falling taste for alternative meats, because it makes sort of core ingredients that go into some of those alternative proteins and alternative meats. So that's one of the reasons it hasn't been doing well. But, Wall Street doesn't like it when you see an investigation into accounting practices. So that really triggering just a huge decline in the shares today.
And the analysts, to your point, they got to work. I mean, a lot of firms took out their red pens today. Number of downgrades on this name, including, by the way, looks like Goldman Sachs. They went to neutral. Price target goes to 67.
All right, let's also talk about a deal here. Fuel distributor Sunoco announcing a definitive agreement to acquire NewStar Energy. It's an all-equity transaction valued at about $7.3 billion, including assumed debt. We have seen a lot of oil and gas deals recently. In the case of Sunoco, this is a diversification play, right? It's a distributor of fuel, i.e. it owns a lot of gas stations here. And in this case, it is going to now be doing more crude oil transportation and storage for the company. So sort of trying to branch out a little bit here, because NewStar owns pipelines and terminals for oil as well as for other fuel-related products in the Midwest and the West Coast. So Sunoco trying to, again, diversify its holdings by making this transaction. But we've seen a lot of, for example, shale deals as of late.
Sure.
And so this is a little bit of a different flavor, but just interesting to see another energy play.
Yeah, an interesting note, too, on the deal from the team at Mizuho. Said they had a mixed reaction. That's what they told their clients. Yes, it's a leap in the company's midstream ambitions, offers commercial synergies, conservative cost synergies. However, for a deal this size, they told their clients, 10% plus accretion 3 years out strikes us as wanting. So they reiterated a neutral call on that name.
Yeah.
Finally, one to check out here. Let's take a look at shares of Rumble. They're skyrocketing as the video platform announcing a partnership with Barstool Sports. The partnership would provide Rumble users with access to all Barstool Sports content on the platform, including live stream here. So this is Dave Portnoy's media company, Barstool Sports. announcing, it sounds like, this kind of partnership with Rumble, which is the platform backed by, we know, Peter Thiel. So it sounds like, Julie, like it means Rumble users now have access to Barstool content. In the press release, Barstool noted it's grown its audience by close to 200% over the past 3 years. It's reached about 1.6 billion podcast downloads. And there's also apparently going to be this advertising arrangement between the two. Rumble, remember, went public through blank check merger in 2022, has not been easy sledding here, though, for that name. It is still down hard from its all-time closing high.
Yeah, and this is, we talked about the sort of Trump meme stock universe earlier. Rumble, I would say, is in that as well. So yes, it has this news today that's giving it a boost, but it also doesn't hurt the halo that we have seen for the other Trump-averse meme stocks, right, that we talked about earlier in the show, DWAC up, as well as Funware. Rumble, because it's seen as a more right-leaning alternative to a YouTube. What it says, the way it describes itself, is it claims technologies that are immune to cancel culture. So you could see why it also gets that kind of bump with DeSantis bowing out of the race.
Yeah, you kind of see the cultural similarities here. Rumble, anti-YouTube, anti-cancel culture, anti-establishment. It kind of aligns with Dave Portnoy's brand, generally speaking, I think you can probably point out. Sure. All right, meanwhile, the Securities and Exchange Commission providing an update on the hack that led to an unauthorized tweet saying Bitcoin ETFs were approved, when in fact we know they weren't. Jennifer Schonberger has the very latest. Jennifer.
Hey, Josh. Yeah, that's right. That hack causing major confusion over whether the SEC had actually green-lighted a spot Bitcoin ETF. And now we are learning new information from the SEC. Apparently, just 2 days after that hack, the SEC determined, according to its phone carrier, that an unauthorized party had gained control of the SEC's phone number associated with that X account and what is called a SIM swap attack. SIM swapping is a technique used to transfer a person's phone number to another device without approval, allowing that unauthorized person to begin receiving texts associated with the number. Access to the phone number occurred through the phone carrier, not the SEC systems. So far, the SEC has not seen evidence that the unauthorized party gained access to the SEC systems, data, or other social media accounts. Once in control of the phone number, the perpetrator reset the password for the SEC X account. Now, separately, we've also learned that the multi-factor authentication was disabled last July by SEC staff because they were not able to gain access to use the X account. It has since been re-established following the hack on January 9th. Of course, recall on January 9th, the SEC's account on X posted a message saying that the regulator approved multiple Bitcoin ETFs, when in fact, SEC Chair Gensler clarified 15 minutes later that that tweet was erroneous and that the SEC's official account had been hacked. An SEC spokesman says that the agency is continuing to work with the FBI, the DOJ, and the Cyber Division of Homeland Security to determine just how this person was able to find out the phone number associated with the SEC's X account and how they were able to get the phone carrier to actually give them that information so they could access it. So still some more fallout here to come, guys.
Thanks, Jennifer. Appreciate the follow-up on that very interesting story. Let's get to some breaking news here. We are watching shares of United Airlines. The stock is up, even though the company's forecast for the first quarter loss is much worse than anticipated. So we should say, first of all, fourth quarter earnings beat estimates, coming in at $2 a share. Analysts had been predicting $1.69. But the company says because of the costs associated with what's been going on with some of the 737s, the idea that some of those planes are still grounded here, that the company's first quarter adjusted loss per share is going to be 35 to 85 cents. Analysts had been predicting a loss of 21 cents. So in other words, the loss, even in a best case scenario, is going to be worse than analysts have been predicting. But the shares were up. And one has to think maybe that's because some of this was priced in already or expected.
Yeah, I mean, that stock
kind of
was beaten down heading into that print. I mean, it was down, Julie, about 7% year to date heading into the print. It was down more than 20% over the past 12 months. So you wonder how much of that might have been priced in. It's an initial nice pop in the after hours move, but certainly a lot of questions here about the Max 9. There was also, there were reports today, by the way, of the CEO, Scott Kirby, and how unhappy he is. His frustration over the quality lapses at Boeing. That's not great news for Boeing. When one of the biggest customers is that unhappy, I don't know, it's a great question for guests we have coming up. What does that mean for Boeing, too?
Yeah, I mean, that report just hitting just a few minutes before, like 10 minutes before the bell or so, that there was that dissatisfaction. A couple of the other headlines I'm seeing, by the way, if you're looking at the full year outlook here, the full year adjusted earnings per share outlook is $9 to $11. The estimate there was $9.45, so that might be another kind of silver lining that people are looking at. And United Airlines is also saying that its cost per available seat mile will be up in the mid-single digits in the first quarter. So that may be something also that that analyst investors are sort of holding on to here.
All right, we've got a very smart analyst coming up to help us make sense of it.
Yeah.
In the meantime, though, let's turn to the presidential election. It's now technically a two-person race for the Republican nomination ahead of tomorrow's New Hampshire primary. But our next guest says no matter the results, former President Donald Trump has the nomination locked up. Joining us now is Henrietta Treyz, Veda Partners Director of Economic Policy and Managing Partner. Henrietta, it is always good to see you. So New Hampshire primary tomorrow, Henrietta, but you say, listen, it doesn't matter the showing that Haley has. You think this is said and done. This is Trump versus Biden?
I get a lot of questions. Thanks for having me, guys, about whether Haley could blow it out, get major leads, and even come first in New Hampshire, whether that would move my needle. And I just can't find a way. New Hampshire is a quirky state that used to be critically important in a contested primary, but this just isn't one. The path forward for Haley is non-existent, and the path forward for Trump is nothing but runway. You got Nevada coming up next, and then South Carolina, Haley's home state, and she's getting routed there by double digits in every single poll. So I don't see a path forward for her beyond tomorrow. It'll be exciting to watch, but that's the end of the story for her until potentially the conventions this summer. But that's going to be a Hail Mary pass, sort of a black swan event that we can't predict at this time.
So what can we predict, Henrietta, then beyond that? I was just at the World Economic Forum in Davos last week, and the conventional wisdom seems there to be that President Trump is going to win re-election. Not that a lot of folks there were necessarily happy about that, but they seem to be at least preparing for that eventuality. What do you think? I mean, I know it's a little far away, but what do you think at this point?
No, that's fair. It's my job to predict, so I appreciate it. I wasn't cool enough to go to Davos, but I understand that a lot of people were wildly not wildly, but overwhelmingly expecting that Trump would win. And that's interesting because when I tour around with investors in New York and around here domestically, I don't get that response very often. It's usually about 80 to 90% of folks expecting that the polls will be tight throughout, but that Biden will ultimately win. And the reason for that is that every polling data metric we have since 2016 suggests that Trump is a turnout machine. But unfortunately for Trump, the turnout when it's high, like it was in 2018, 2022, and in the referendums we've seen from Ohio to Kentucky over the last couple of years since the Dobbs decision, is that high turnout benefits the Democratic Party. And you can see that in the House, the Senate, and obviously the White House, given that Biden is the president. So I think that unique set of circumstances where you see the polls suggesting they're neck and neck is really not indicative of how turnout ultimately lands. And the way that I phrase it to investors is I think Trump is at his ceiling right now. He's got the lowest disapproval ratings that he has seen since he left office, which is a weird way of saying he's got his highest favorable numbers, while Biden is at his floor. And that's happening just as economic data is turning a corner on the consumer sentiment side, which is a lag from what economic data has been telling us fundamentally on inflation, GDP growth, and unemployment for many months now.
On the other hand, Henrietta, I've seen some numbers recently for Biden that look terrible. And I'm looking at this recent ABC Ipsos poll, Henrietta, 13% of Americans, just 13%, say they've gotten better off financially since Biden took office. That sounds terrible.
It sounds horrible. And I think a lot of that is not home prices, but grocery store prices, and also gas prices having been high. One of the things that you note in the economic data and the polling data is that there's a tremendous lag between voter sentiment starting to change, economic sentiment starting to change, and then the polls sort of baking those numbers in. Voters tend to bake in their opinion of the state of the economy months before the polls are asked. You can see that oftentimes it'll be 5-6 month lags between what voters feel their state of the economy is, feel what their household projections are, and who they want to vote for as a result. And so we're just now on the upswing of that. And you can see that in some of the data out of Nevada. I just published a note a little while ago for clients. The Democratic voter base turning and coming home to Biden. And the reason for that is not going to be just because the economy is improving, but also because Trump himself creates such a negative backdrop where they go to the party candidate that they would more often or prefer to have when Trump is at the top of the ticket. Another big thing there is that a lot of voters expect, and a lot of investors too, anticipate that there will be another person that enters this race, whether it's no labels, a last ditch effort for Nikki Haley, something at the conventions, Dean Phillips, Marianne Williamson, those people are brought up regularly in every single meeting that I'm at. And I think what we're waiting for really is for voters to come home to their parties. And again, I would say I think Trump has already secured that. Biden has a lot of work to do, as you accurately point out.
I have to admit, I forgot Marianne Williamson existed until you mentioned that name, Henrietta. So there's the perception of people's economic well-being. Would President Trump make it better?
Well, I think President Trump would have a long way to go just to keep it the same. So, for example, the tax cuts that he passed in 2017, those all expire at the end of 2025. So it's going to cost $2.7 trillion just to keep the status quo from a tax perspective. So Trump's going to have to increase the deficit, as would Biden, in order to just keep that flat. Inflation, having been handled by the Fed for the last several months in sort of spectacular fashion, is still going to be on its come down and decline. We expect the economic data that we see later on this week to continue illustrating that. We are on an upswing, and certainly compared with the international community, the United States is in a far better position than anyone else out there. And I think the question is, how long can that be sustained? With the Fed expected to drop interest rates, the question I have for the Biden administration and for the economy and people's sentiment around the economy is, will they start to reduce interest rates on time or in time for that to bake into voter understanding or sentiment around the economy, as you point out with your previous question?
Yeah, especially since they're at pains to avoid the appearance of helping either side. Henrietta, thank you so much. Appreciate it.
Thanks for having me.
Coming up next, we're diving deeper into United's fourth quarter earnings with an airline industry expert, plus the state of oil and gas after a major attack on a Russian oil depot. That's next on Yahoo Finance. United shares are jumping after reporting better than expected fourth quarter earnings, although the first quarter forecast leaves something to be desired. Here to discuss United's latest report on all things airlines, we're joined by Mike Boyd, Boyd Group International President. Hey, Mike. So we're looking at the stock reaction and we're a little confused here because the first quarter loss forecast looks pretty negative. But is it because people are just putting it all down to what's happening with these Boeing jets and not about demand? What do you think's going on here?
No, United's right on the money here. We were just looking at it this morning. The third and fourth quarter are not going to be as rosy as we thought it was going to be. We do have inflation. We do have discretionary traffic starting to decline, if you will. That's the ultra low-cost carriers are saying, but United will too. But United's prepared. They understand the international marketplace. So it will be down. There's no question. But United will be on top of it, put it that way.
And Mike, do we have any sense here, your expectations in terms of timeline of how long the MAX 9 could really be parked?
Well, I'd be in Las Vegas making book if I knew that. It's really tough. But right now, we got a really ugly situation. Now they've added the 900 ER. That's another 163 airplanes that United is flying through the skies that might get grounded. And what I really fear here is the public's going to get spooked on anything with the letter or the number 737. We have the first ones, that was 79 of their airplanes, 6 on order, not delivered, and now another 163. I really don't know, but whatever it is, Boeing's got a lot of yogurt to get through, put it that way.
I mean, should they be spooked, Mike? Would you fly on one of these things?
Yeah, I probably would. I grew up in this business, and I don't have really good sense in some cases. But the fact of the matter is we do have a situation where we do have an FAA that's on top of it. But right now, if they find anything else going on with production at Boeing, I think there's going to be fallout like we haven't seen since, I would say since the COVID issue. So let's hope that doesn't happen. But yeah, I have concerns with manufacturing when you have things not screwed on right. That's not a good thing. What system allowed that to happen? Don't have an answer yet.
And Mike, it was interesting. We had these reports today, United CEO Scott Kirby apparently not happy, Mike, at all about these quality issues at Boeing, venting his frustrations apparently. That doesn't sound like good news at Boeing when one of your biggest customers is that unhappy, right?
Well, of course not. When they're the biggest customer for the 737-10, and Mr. Kirby has a red pencil too. He can draw a line through that if he really wants to. They have 100 of those on order. So Boeing better toe the line here, but Scott is entirely right. You don't take 79 of their airplanes and have them grounded, and now there's another 163 900 ERs that might be affected too. I would suspect Mr. Kirby is on the warpath.
Does Airbus have the capacity to pick up the slack if indeed these Boeing orders get canceled?
Not a chance. Boeing's dance card is filled until 2030. I mean, this is why we saw JetBlue trying to buy Spirit. They wanted the airplanes. They didn't want the routes. They didn't want the airplanes. There are none available, so Airbus can't pick it up. That's the end of the game.
And Mike, the other big news for the industry, obviously, we're talking a lot about is this federal judge blocking JetBlue from merging with Spirit. How does that impact the big U.S. airlines, Mike? Is that actually good news? No big rival to really threaten their dominance?
Well, it really wasn't a merger where two route systems are being taken over. It really was an asset buy, as I just said. JetBlue wanted the airplanes and the crews to use to expand. My take on it, it would have improved competition in America because JetBlue is an impulse carrier. People see a low fare, they go to Florida. Spirit is an impulse carrier. JetBlue is a mainline carrier that could have competed a whole lot better with those immediate 200 airplanes with United, Southwest, Delta, and American.
And Mike, I'll get you out of here on this. So we've heard from United, at least initial reaction here in the after hours. Investors seem to like what they heard. We've got other airlines, though, on deck, Mike, American, Alaska, JetBlue. Do you expect, generally good results from those?
No. I mean, at least the going forward picture for Alaska, they're being pilloried by this. Almost 1/3 of their fleet is now grounded, not flying. That means about 35% of their seats aren't being sold. And JetBlue is having issues too. Look, we do have problems at the periphery. And what we see here is it's not going to be a 5% growth as we thought it was going to be. We think more like 3 in this year. and they're adjusting to it. So I don't see good news happening only because of the Boeing thing at Alaska, and JetBlue has to restructure now because they're not going to get those expansion airplanes they could have gotten and improved competition in America with that merger.
Mike, I always love having you on. You always teach me something. Thanks for being on the show.
Thank you, sir.
Oil prices higher after Ukraine reportedly attacked a major Russian fuel terminal over the weekend. According to the Wall Street Journal, Yahoo Finance's Inez Ferre joins us now for more.
Yeah, Josh, and that Russian fuel terminal impacting supply, or at least stoking concerns about supply. One analyst saying that about 700,000 barrels per day of exports that are supposed to come out of that terminal are being delayed because of those drone attacks. Also, why we're seeing prices higher today? Well, that has to also do with the cold weather in the U.S. If you take a look at our Wi-Fi Interactive, you'll see the price action that you saw with WTI, West Texas Intermediate, and also Brent crude. And you'll see this outsized move when it comes to WTI. Well, the cold weather impacts, of course, cold weather can impact demand because people will not travel as much. Perhaps they won't get on as many planes. But cold weather can also impact production. And state officials in North Dakota are saying that about 20% of North Dakota's oil output has remained shut because of extreme cold weather. Production in North Dakota is estimated to be down about 250,000 barrels per day. And North Dakota is the third largest producer of oil behind Texas and New Mexico. And also watch out for refineries that may be interrupted, because analysts are talking about perhaps we may see some price swings when it comes to gasoline, refined fuels like diesel, because of the cold weather impacting refineries. What will counterbalance that is the excess builds that we have seen with refined fuels over the last couple of weeks, guys.
Thanks, Inez. Appreciate it. Well, coming up, 2024, already seeing a number of deal announcements in the health space. On the other side of the break, we're joined by an expert to break down what these deals mean for the sector moving forward and what could be next. Stay tuned. 2024 has already seen a number of deal announcements in the healthcare space, this coming after biopharma deal-making saw an uptick last year. According to EY, 67% of mergers and acquisitions investment came from big pharma last year. That's up from 38% in 2022. Joining me now, EY, America's industry markets leader for health sciences and wellness, Arda Ural, along with Yahoo Finance's Anjali Kamlani. Arda, thank you so much for being here, first of all. You were just telling us in the break that not only did we see an uptick last year, we really saw an uptick at the end of the year in this activity. What happened? What was the motivation for that?
Yeah, indeed, we typically look at a number that is $200 billion as a value of the total deals. And it was creeping up to the 200, but in the last couple of weeks of the year, we saw a mad dash, going over 215 billion. The reason for that is multiple, but one of the signals that the industry was waiting for was how is the kind of uncertainties going to resolve over the next couple of months. And when the Fed gave the signal that they will pause the hikes, I think that was a good relief for the industry. And the other thing is the industry has been waiting for replenishing the top line with the right assets, with the late de-risked assets. The industry has a challenge of in the amount of $350 billion over the next couple of years between 23 and 28 to replace the loss of exclusivity that's resonating from coming from losing the patents of some lead biologics products. And as a result, that was the secular need is there, the trend is there. They were just waiting for a signal. I think we expect the deal momentum in 2024 will continue on that front.
That's definitely good news. I'm glad you brought up LOEs because we know that that is one of the key focuses for a lot of large cap companies looking at $192 billion hole for the next 4 years, including this year. And that is with $1.37 trillion in firepower, as you put it in the report. So talk to me about that, because that is, we're looking at almost double the loss of exclusivity since the last 4 years. So that is a lot of firepower on hand, plus the complications of the IRA and the political landscape coming up this year. What do you think are some areas that M&A is going to happen?
Yeah. So as you indicated, Anjali, the need is there because they need to replenish. But also the balance sheet strength is there. That's what we are measuring since 2014. Now the number for them to deploy as a capital is $1.4 trillion, which is all-time high, matched to what we had last year. And now I think we are seeing the balance sheet converting to income statement. The challenge here is for the industry, are there enough assets in the de-risk late stage, on that development front, in that maturity for them to bolt on, to continue? For that reason, what we see is like a tale of two cities in the biotech. Those who have the late assets, products coming to market or in market, saw about 73% premium one day post-deal announced versus 50+% last year. So you saw assets kind of really picking up. This is the kind of a good side of the tale of two cities. On the other side, the innovation obviously coming from startups and earlier stage companies. 27% of those companies in the biotech do not have cash to sustain their operations over a year. So you got literally kind of really in the biotech, you're seeing a tale of two cities.
So when you see those different stage companies, that's one part of it. But the other part of it is the treatment areas that are going to be hot, right? Oncology, which has been hot, probably going to continue to be hot. I'm curious if you expect any chasing of the GLP-1 trend. Are there even any targets out there that would make sense in that universe?
So I agree. I mean, oncology has received the most premiums. It's like 12 times or enterprise value multiple for that, and followed by blood disorders, inflammation, and immunological disorders, and it kind of goes from that 12 down to there. And then if you look at is that going to continue? Oncology is a big unmet medical need. I think it's also from a reimbursement perspective, it is less challenged. There's a protocol, there's a treatment guideline, established mechanisms for pharma companies and innovators to come there. I think we expect this to continue. On the innovation front, the GLP-1s, obviously big innovation. They have been around since 2005. It has been an innovation on their delivery mechanisms, and there's a long pipeline of those assets waiting to be maturing over the time. So we will see more activity, and it's also very good for overall healthcare because diabetes and obesity are two major factors for cardiovascular disease, for cancer, for orthopedic diseases, a very long list.
I know that you mentioned some of these companies that just have a year cash on hand, really waiting for that firepower to come from the big pharma and large cap companies. What did you see at JPM, and what did that tell you about sort of where there might be a focus or where the energy is right now?
Look, I think it really depends on which company you're talking. Our report obviously gives the snapshot of the industry as an average, but it doesn't apply to any single company because everybody has their own priorities. So when you see in the JPM, this is the annual healthcare conference, which is really where we keep the pulse on the sentiment of the industry for the following year. Last year, when we actually talked, it was just really matching the weather report, which was like very doom and gloom and storms. This year, I think the sentiment, I went there being cautiously optimistic. I came back as optimistic. I think that was the sentiment that was uplifting. It was really a vibrant environment with innovation, a lot of startups seeking funding. And I believe there's still private equity is sitting on the sides. They will deploy their capitals. And also, if you look at the bond markets, there's however is calculating $6 to $7 trillion sitting on the sidelines, which need to get back into the equities. I think all of that will have a positive impact. And also, as we indicated, the uncertainty about the monetary policy is now to a large extent resolved, notwithstanding, of course, geopolitical blow-ups or other issues. And then the other thing, if I can add, is the Gen AI has been very exciting. It's yet another innovation that's going to help with expediting R&D, expediting back office processes to lower the cost of running business.
So, in other words, more deals to come, most likely this year.
We expect it to be a strong year in 2024.
Yeah, feels that way. Ardo, Yoel, thank you so much from EY, and of course our Anjali Kamlani as well. Thanks to you both, appreciate it.
Thank you.
The Dow closing above 38,000 for the first time ever. Jared Blickery here with the recap. Hey, Jared.
Yeah, Dow record high, S&P 500 record high, Nasdaq 100 record high, but not the composite. And the small caps, Russell 2000, it was the leader of the day, up more than 2%, but it has a ways to go to get to those record highs, to get into that club itself. But here are the individual names. And as I've been saying for a couple of weeks now, we're seeing a broader and broader range of names hitting these highs every day. Apple's not in there just yet, but it did turn positive for the year. Here's NVIDIA up to a record high. Same with Broadcom. Merck, you like the pharmaceutical? There you go. MasterCard, Visa, ServiceNow, Regeneron, FICO, Fiserv. So lots of different ranges, or lots of different record highs here from pharmaceuticals and healthcare, and also to, let's see if we get my screen back here, and also some others. What we're not seeing is a lot of action in staples and utilities, and we can see that where that browns out the bottom tier right here, along with retail. However, this is a pretty bullish setup. Industrials leading the way today, followed by financials, real estate, tech, healthcare, and energy. And let's take a look at the Nasdaq 100. I mentioned Apple today finally clawed back its losses for the year. And let's put a 3-month chart in and put some candlesticks. We can see that dip here, which was scaring a lot of traders. And we do have some concerns with Apple and its rate of growth. We've seen the best 3-day move here that we've seen in almost a year. You'd have to go back to February of last year to see a better run for Apple over 3 days. And when we take a look at the year to date, we really see the outperformance, again, of the mega caps, but also of growth. And we're not seeing too much action in the mega caps right here. I would note that one sore spot is Tesla continuing its downward run for the year. That is down 1.6% for the day.
Thanks, Jared. Appreciate it. Coming up, we're going around the horn, checking in on some of today's top trending stories, including a yearly subscription date night pass to Applebee's. Stay tuned. We've got more Yahoo Finance after this.
Hello and welcome to Yahoo Finance's group chat. I'm Alexandra Canal here with Josh Schaefer, Supermanian. Today, guys, we're starting with a story that's close to my heart and wallet, I should say. The rise of single women taking over the housing market. Half a decade ago, women couldn't even get a mortgage, and now it seems like girl power is in full force, at least according to this new analysis from mortgage platform Maxwell. Now, in the report, the female homebuyer who applies for a solo mortgage climbed to 22% out of the entire market last year. And like I teased, I am currently in the process of maybe purchasing my own apartment here in New York City. It's something that I've been thinking about. I'm 30 now. I feel like I need to get that next step, build some equity. But this study was really interesting. There was a few things that stuck out to me. One, the ages of single women applicants. 35% are between 25 and 34 years old. So not just millennials, also Gen Z. They're looking to get into the market. Also, if you compare the yearly comps, the income that women are making versus men, the majority are making less than 100K and exploring these possibilities. So 37% of women and 31% of men making between $50,000 to $99,000 in a year are looking to potentially purchase a home. Now, again, New York City, a little bit of a skewed market.
Look at Process Face. Not everyone that answered the survey.
And a lot of women that are looking for homes, 64% say they are willing to relocate to an area where they don't have to pay as much. So that's something that they're willing to do in order to get that equity.
Yeah, I mean, one thing that stuck out to me just when we think about having purchasing power was thinking about the labor market and the fact that more women have jobs now than they did maybe, say, go back 40, 50 years ago. I'm obviously going back a relatively long period there. But when you look at women's participation in the labor force, what sticks out to me about this chart mainly, guys, is basically from about 1990 through now, you can see that big increase that we've pretty much held, and it also came back over the pandemic notably. But holding that for such a long period of time, when you think about the last 15 years, or the last 10 years, if we're talking about someone that's 35 that wants to buy a house, having more women in the labor force makes sense to then bring up stats like wanting to buy a house.
Yeah, and I mean, I'm surprised that you look at that stat again, 43% of households are now headed by women. And I think I'm surprised it's actually that low when you consider like single child households or women are just always, they're dominating that household formation and that smaller kind of cohort, right? Also, you mentioned this Gen Z millennials, they were the largest share of single women mortgage applicants in 2023. So these younger buyers who may not have like a ton of money, but they're looking to buy a home, maybe it's somewhere else, but they're aggressive about it, right? And I feel like with that kind of below $100,000, it's hard to buy a home.
And it's interesting because even women that are in long-term relationships, they're opting to buy a home on their own. Maybe they're the breadwinner, or maybe they're thinking about things in a different way and they want to have that ownership. So I think it's a big moment.
Or they're making more money than their partner, right?
Exactly.
So speaking of more money, from girl power to beast mode, Mr. Beast, one of the biggest YouTubers out there, maybe eyeing a deal with Amazon Prime. That's according to reports from news site Puck.com. Puck's claiming Beast may get an exclusive deal worth $100 million. Now, Beast has over 230 million subscribers, so I'm not surprised he's getting a huge, lucrative deal. But can he convert all of them to sort of log on and pay for Amazon Prime when they get it for free on YouTube? That's my question.
Yeah, no, it's a big question, Bros, right? When you think about something that people were getting for free and then putting a price tag on it, I think you can ask a lot of newspapers around the country how that goes after a while when you put stuff out on the internet for free. And then you say, actually, this is really premium content. You should be paying for it. Some industries haven't had great success for that. But Allie, kind of in your space, thinking about Amazon spending $100 million here, to me, it seems like it's very in line with, say, their NFL spend, right? Maybe overpay by some respects for what you're getting, but it gets you exposure to a new, probably younger cohort that might not have Prime yet.
Yeah, look, they have the cash, right? All these tech companies have the cash to spend. And while we're seeing media at large pull back on a lot of their content spending, we're seeing these tech companies do the opposite. But I want to go back to your point about how, would the consumer be willing to watch something if they have to pay for it? I think there's less of a barrier to entry when you think about something like Amazon Prime Video, because most people out there subscribe to Prime, or at least you're getting something else with that. Now, at the end of January, Amazon is going to start rolling out ads unless you pay for a premium premium Prime subscription. So I'm curious how the advertising game is going to feed into all of this, because we know YouTube heavily relies on ads. That's one of the main ways that a lot of these YouTube creators make their money. So how is that going to translate now that Amazon is entering the AVOD game? And what does that mean for some of those creators and producers?
I'm just sort of reminded of, older people like myself. Remember Howard Stern going from free radio to Sirius XM and bringing a ton of people over. They converted, they pay month to month for Sirius, and they're actually done quite well. And then most recently, Joe Rogan with Spotify, it seems like that's going well. They paid him, I think, $100 million for like a 5-year deal.
If you have the following, I think people will follow you wherever you want to go. I mean, if you have that dedicated fan base, I think that's step number one.
We'll watch Mr. Beast maybe in an Applebee's. That's my story today, guys. We're taking a look at Applebee's. Applebee's out with a brand new promotion that is already sold out. The chain's new $200 date night pass sold out in minutes. It offers up to $30 off meals for two every day of the year. Now that's a lot of bottomless wings, of course, guys. So you can use this pass up to 52 times. And you get the $30 off. You can use that 52 times. Applebee's pitching that turns into about a $1,500 value over the course of the year. It's also a lot of trips to Applebee's, and it seems like a relatively smart play because $30 off food, there's not that many times that I know I go to a restaurant on, say, a date night, and you're only spending $30, right? And drinks are not included in this. So Applebee's finding a way to get people in the door and then just try and make more money off you once you're in the door, it seems.
Yeah, and I think back to our good old CPI report and inflation and how food prices continue to soar, especially food out of the home. That has slowed. Really, when we think about the price here, at the last report, 5.2% on an unadjusted basis over the past year, second only to rent. So really sticky prices here. If you compare that to food that you're cooking at home, grocery store shopping, it's a lot higher. So if you're going out to these restaurants, you're spending a lot more. I think all of these companies, they want to have discounts, they want to have promotions, they want to have a little subscription rollout there.
You got to be an Applebee's subscriber now to afford it.
Well, it gives you, it gives the illusion, whether or not you think it is a good deal or not, that there is some value there. And I think right now in these times, that's really important to consumers.
I mean, I was surprised that I thought, who's going to want to do this? Who's going to want to get this Applebee's subscription card? And then it turns out, reports that the site was crashing today, and then Applebee's said, quote, due to popular demand, the Applebee's date night has sold out. It's done. It's over. You can't get it anymore. So
what are you going to do, Praz?
Yeah.
You wanted to get it.
You missed your opportunity, Praz.
I mean, I guess if I was single and I wanted to go on a bunch of first dates, this is the best.
Well,
best
I think the other part of this, too, that we should, it's called date night, but you and I could go, too, and we could just get the bonus wings.
Look, Valentine's Day is
like, I think it's a good pitch. It's just a two-person value, too.
For V-Day coming up, they're saying, hey, if you need a little suggestion, why not go to Applebee's?
All right, we got to get online.
Bills Ravens, man.
Bills Ravens. Pras and I are going to get a reservation at Applebee's. That game will not be happening because the Bills lost. But up next,
Chiefs Ravens.
Coming up, we're going to bring you what to watch tomorrow. We break down the stories you need to know to start your Tuesday.
Time now for what to watch for Tuesday, January 23rd. On the earnings front, ahead of the open, we'll hear from Dow Components, Johnson & Johnson, Verizon, and 3M. Defense giant Lockheed Martin also set to post results in the morning, but the big name to watch is after the close, and that is Netflix. Subscriber numbers expected to rise by roughly 9 million as investors look to see how the password crackdown and the ad tier help drive revenue growth.
And the first primary of the 2024 race taking place tomorrow in New Hampshire is coming in the wake of Florida Governor Ron DeSantis suspending his presidential bid and endorsing former President Donald Trump. There'll be a test for Nikki Haley as she tries to show she's the alternative to Trump.
Oscar nominations coming out tomorrow for the 96th Annual Academy Awards. Barbie dominating the box office in 2023, grossing more than $636 million. We're going to find out the nominees for all 23 categories in the morning. Now, as to kind of what we're zeroing in on tomorrow, I know you're looking ahead to those Netflix numbers.
We got big earnings on deck with Netflix. The stock, Julie, basically flat so far this year. It's up about 35% in the past 12 months. Key metrics to focus on. Street's looking for about 11% year-on-year growth on the top line. Subscription net adds. We did have Michael Pachter on Wedbush come on, told us he expects solid subscriber additions. Says Wedbush conducted a survey, saw some real traction on both the ad-supported product and on the password sharing crackdown.
And I'm looking at the others, right? I'm looking at Johnson & Johnson, Verizon, 3M, and Lockheed Martin. Now, all of these have one thing in common. Do you want to guess what it is?
No, tell me.
They've all underperformed the S&P 500 over the past year, which means that there's a decent amount riding on these numbers, particularly when you look at a Verizon, for example. Analysts are looking for the company maybe to turn around its mobile business, to improve on subscriber growth there. We're going to be looking at the med tech sector for Johnson & Johnson. But whatever the particulars of these companies are, again, they've been underperforming. So investors are going to be looking for some potential catalyst to turn that underperformance around.
Showtime.
Exactly. Yeah. Showtime. That's what they say on the subway. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell. Have a great night.